Welcome back to the Essentials of Entrepreneurship. This is Module 2, and we're going to talk about entrepreneurial finance. Okay, you've got your first-person opportunity. You're ready to move into the formal evaluation of this, and what we're going to have to do now is we're going to have to do a feasibility study. Okay, so you're going to sit down, open up Excel, and start plugging in some numbers. Now, what are we going to produce? Well, in Excel, we're going to produce an income statement. We're going to produce a projected income statement. Well, how do you produce a projected income statement for a business that doesn't exist? Well, we're going to use research. We're going to use best guesses. We're going to use hopefully conservative projections, hopefully. But we're going to produce a income statement. We're also going to produce a cash flow statement because we need cash in order to evaluate our opportunity. We need cash flows. Okay? So, income statement, cash flow statement. How about a balance sheet? Now, I hope you're not sitting there looking at me going, what's a balance sheet? In fact, I hope you're not saying, what's an income statement? What's a cash flow statement? But don't worry, if you don't know what they are right now, we've got a quick fix for that. Balance sheets, some people ask for them, some people don't. Balance sheets, because of the nature of what a balance sheet is, it can be very ambiguous. It can be very ambiguous for a projected business. So you may not want to do a balance sheet. I only do balance sheets in my financial projections if the client asks for it. If the client says, I want a balance sheet, I give them a balance sheet. Otherwise, cash flow, income statement, that's really what we want to use. Okay, so our financial statements. Now, do you want to start with the cash flow statement or the income statement? The answer is it depends. It really depends on the nature of your business. Sometimes it's easier to do the cash flow statement first. Just look at the flows of cash and how they're going to come in and out of the business, and that one is a lot easier. Sometimes it's easier to start with the income statement. Now, my income statements and cash flow statements are going to look very similar. Okay, I'm not going to use the reduced common cash flow statement format that you see published in financial reports. No, my cash flow statement is going to have more or less the same line items of income, of revenue, the same line items of expenses that my income statement does. And I want to do this monthly. Okay, and I say this all the time. I teach this in class. I teach it for an entire term, and my students come back and they bring me, quarterly or annual, right? This doesn't help me as an entrepreneur. Okay, I need to know, especially when I get to my cash flow, where is my cash flow monthly? The fact that my cash flow is positive at the end of each quarter does not necessarily mean I had the cash to pay my salaries in month 1 and month 2 of that quarter. If that cash all came in month 3, well, then it's never going to happen because my employees are probably going to walk out in month 1 or month 2 when they don't get paid. Do it monthly. The reason for this, reason 2 for this, is that you're on Excel. It's easy, right? You're dragging and dropping. You're dragging formulas across. To do 60 months is as easy as to do 5 years. It's the same. It's just dragging it out, okay? Also, when you want to make it quarterly or annually, right, it's easy to do it from a monthly. Whereas if you've done quarterly or yearly and now you need monthly, that's difficult. Do it monthly. Monthly income statement, monthly cash flow statement. Okay? We're going to do them monthly. These are going to show us how our business is going to perform, what we're expecting. And in terms of the cash flow statement, the cash flow is going to tell us how much cash do we have, how much cash do we need, when do we need it. It'll also tell us about break-even. Now, this break-even, if any of you have ever performed break-even analyses before, there's a couple different kinds of break-even out there, right? There's break-even that we perform in business all the time where we talk about a product or how many units or how many sales that this business needs to perform to break even. This is not what we're talking about here. We're talking here about investment break-even, right? You are going to put money into this company. If not, somebody else is going to put money into this company. When are they going to get their money out of the company? Okay, that's a break-even. There's another kind of break-even that's on the same scheme, basically, the same cash flow statement. We can also calculate what I call operational break-even, right? Which is, at what point is the business running without further injections of cash? So when is the business able to sustain itself? And then when does all the money originally invested into this business, when does it start growing and come out the other side and finally have paid back more than what was put into it? So that's investment break even. And we're going to see this all in the cash flow statement. And that's why the cash flow statement is so extremely important. So we use the cash flow statement for a lot of operational things in seeing how our business is going to do operationally. How about the income statement? Well, the income statement really is going to show us the book profitability of this venture. It's also, like the cash flow statement, going to help us control expenses, and it helps us with scenario evaluation. Okay. Now we're going to do scenarios in both. Now, and the way that we're going to put these together is you're going to use one Excel file, and one sheet of Excel will be your cash flow statement, and one sheet will be your income statement, and they're going to be linked. And this is one of the best pieces of advice I can give you. Link everything. Link everything. Because when you're evaluating your business, you go, well, what if we charge a little bit more for this product? Or what if we think, no, we thought we were going to sell more of this, but now we're going to sell more of this? Or what if we can actually get this supplied at a lower cost? You go in and you change the one thing, and it changes everything, right? Because you create your income statement and your cash flow statement, and they're linked. So what I like to have is I actually like to have, tab 1 on my Excel will simply be basic info, right? And I start putting assumptions in there. And that's the only place where I ever change those assumptions. Okay, and as I change them there, they get linked over to other tabs in Excel, and they update everything. So make sure as you're putting together your feasibility study that you link it up, that you have as few open cells, loose cells as possible, so that and that you have one page somewhere that shows you kind of the main variables and the main data points that you're working with, so you can see it all in one glance. And what I often do is when I'm ready to present that to someone, I clean it up and basically just call it my basic info sheet, in which case that you can look at and you can see this is what I'm selling. This is how many I think I'm going to sell month 1, which equates to this year 1. This is the price. This is the number of customers. It has all that information kind of right up front, and that's very nice and clean for investors. So you get these sheets together, and you can now start running some graphs. And investors love graphs because now they don't have to look at cells and cells and cells full of numbers. They can start looking at the visualization of things. So you can do something like you see here. You've got 5-year projected net income, okay? And here you also see some scenarios, right? You can see that there's a probable case, there's a best case, there's a worst case scenario. Scenarios are good for you, and they're very good for an investor because we're predicting the future here. And we want to use a base case scenario based on what the market research, what the market data indicates we should have. In fact, once you become very experienced in it like myself, what you really do is what the market predicts is really your best case scenario. Then you throw some flies in the ointment, as we say. You throw in some, well, what if something happens and we don't start off as quick as we thought, or we run into a problem here or there, and then that's the base case. And then we throw something even worse into it. Well, what if there's a shortage in the supply of a certain element that we need to get this done, and you create a worst case scenario. And so you have something very strong and robust to present because you've actually studied different cases and what will happen in different scenarios, and you have a plan for how you're going to deal with each scenario. You can then take this information and you now know how much you're going to need. Okay? How much investment is this company going to require? How much is this company worth? Because once I've got a cash flow statement, I can discount my cash flows by a determined discount rate, and I can come up with a value. This is important if I want investors. Because if I want investors, I need $50,000. Well, what is $50,000 worth? If any of you have watched that program Shark Tank, right, where people, uninformed entrepreneurs, just kind of walk in and they say, I need $50,000 and I'll give you 5% of my company. Well, basically you're saying that $50,000 is what 5% of your company is worth. Okay? So what is that? Is that $2 million is what you're saying that company is worth? Well, show me that company is worth $2 million. You see, if I say I want $50,000 and my projected cash flows show that my company is worth $100,000, then just to be fair, $50,000 is half of my company. That is what it comes out to. That's the way it is, right? Determining how much of our company we give for how much equity is not an arbitrary thing, especially not to an investor. They want to know that they're getting their fair share for what they're paying. Okay, so we have all this put together. Once we've got our income statement and our projected cash flows, we can get an actual value of that business. The other thing that the cash flows show us, especially on a month-to-month basis, is that they show us when we need that cash. You see, we could determine that we're going to need $50,000 worth of cash, but you don't need it month 1 or month 0. You maybe need $10,000 to get up and running. And then when you hit a benchmark, you're going to need another $10,000. And then at another benchmark, that's when you'll need another $10,000, right? And people are much more willing to invest smaller amounts of money at a time, seeing the progress that you're making, right? Than they are investing a bunch of money up front. Also, the more that your business progresses, the more your business actually will be worth. So maybe they get 10% of your company for the first $10,000 they give. But on the second $10,000, maybe they only get 9% now because we can see that your company is worth more money, right? So it's also a way of maximizing the money you can get and minimizing the equity that you have